We're live here on Liberty and Finance with Gary Wagner from the Gold Forecast. Gary, thank you so much for joining us today.
It is great to be here, and what an interesting day to do a live podcast on with the CPI numbers coming out today. It's certainly a pleasure.
Definitely. So we pretty much have the highest inflation we've seen in almost 40 years. The CPI coming out at 6.8%. There's going to be a lot of people saying, well, that's an underestimate. I know there are a lot of other people looking at inflation and saying it's a lot higher than that. But even by the official numbers, it's the worst we've seen in 40 years. Your perspective on where we are right now and what this means for us.
Well, let's take a look at what's led up to this. And I'm not going to talk at the beginning of 2020, but the economists that have been polled by Bloomberg and Wall Street Journal, for the most part, since about June, have gotten it right on the money. They'd be off by maybe 0.1%. They were calling for 5.4%, then it would come in at 5.3%, right in that area. Now, those at that time were record numbers, and they were right on up until October. And in October, we were sitting at, I believe, 5.2 is what the prediction was. It came in at 5.8. And then, the prediction was 5.8 and it came in at 6.2. And then here, they were once again on the money. They were looking for about a 0.07 to 0.78 increase. It's exactly what we saw. And we are sitting at 6.8% inflation. As you said, go to the gas pumps, go to the supermarket, try to buy goods and services. It certainly feels as like that is a really low number. And what does that mean to individuals? The costs of goods and services are getting extremely expensive, more expensive than ever. For those that are living on fixed income, that is really hurting their ability just to survive week to week. And we're still in the midst, whether it's at the tail end of a pandemic, we most certainly are in the area where I can say we are deeply in a recession. And so we have got some issues that have to be solved. The question is, we know from what the Federal Reserve said, especially Chairman Powell during his testimony to the Senate Banking Committee, that they acknowledged really for the first time that they underestimated the pace at which inflation was rising and how long it would last. I found it odd that he said, well, we're going to remove the word transitory. That wasn't odd, but he said the reason for that is transitory means different things to different people. I don't know what people he's speaking about, but what it tells me is the Fed is having a difficult time being forthright, being transparent, and acknowledging really where we are in the current state of affairs. That's the first thing. The second thing is with inflationary levels this high, there is no solution, no tool in the Federal Reserve toolbox, zero solutions in which you can lower inflationary pressure and not have a detrimental effect on the economy and the economic recovery. So the Federal Reserve is walking kind of like a tightrope, a balancing act, in where if they act too quickly, it's adverse effect on the economy. If they act too slowly, inflation continues to spiral out of control. Neither is an acceptable answer. So what does the Federal Reserve do? And that's why there's going to be so much attention placed upon the upcoming meeting next week, concluding on the 15th. Most importantly, the revised dot plot. We haven't seen one for a while. And the sense is, from what I've read, is because they were expecting it even higher in terms of the inflationary number that came out today, that they might go from, it was anticipated they're going to do 3 to 4 rate hikes next year. Now they're saying maybe 2 to 3. In other words, even the analysts are confused as to what are the future actions of the Fed because they're faced with such a difficult, I believe, almost impossible task.
And where do you see this inflation heading? Because you mentioned how the Fed is really faced with an impossible task where they're supposed to get inflation under control, but at the same time not have the markets crash, right? So
Correct.
going forward here, I mean, what has happened in history? I know you recently put out a video explaining how really what we saw back when inflation was this high is it took about 3 years to get this under control. And that happens if the Fed is aggressive. So what do you see for this situation? Because it's like, yeah, the Fed is really stuck. It's like even if they're aggressive, it'll still take 3 years to get this under control.
Yeah, and that's the key. And that's something that very few analysts are talking about. What I did is I looked at one of the worst recessions since World War II, which occurred in 1980. It really started in the end of the 70s. It was a oil embargo by Iran, excuse me. There were lines at the gas pumps. I was young enough to drive and remember that well. It was a completely different scenario than what we're facing today, except that we are having a recession in both cases. What I found most interesting is, first, we were at a much higher level. 1980, we were looking between 14% and 12% in terms of inflation rates, and they raised interest to double digits to try to bring it down. That crashed the economy. And even doing that, it took a long process to go from double digits. By 1983, they were trading anywhere between 3 and 4% in terms of the inflation rate. Granted, the target is 2% inflation. The Fed would be gloriously happy if they got it to 4%. I think that they'll have to adjust that. But the key is, no matter how they do that, how aggressive they are, it is a multi-year, not a multi-month process. The quicker they do it, the more they open up the likelihood that they will undo the economic recovery that they've worked so hard to create. We have put in trillions of dollars in fiscal stimulus. The Federal Reserve has swelled their asset balance sheet now. They are going to taper and accelerate, but about, I believe, $8.4 trillion. So even once they begin to taper, that doesn't mean they've stopped buying. Now, originally the plan was $15 billion a month, taking us till June. $5 billion in mortgage-backed securities, $10 billion in U.S. debt instruments. However, even if they try to wind that down instead of 15 to 30 or 60, some extremely compressed number, that is going to have an initial effect because it's going to dry up the money supply. Granted, they've still got this huge balanced asset sheet to work from, but they're not putting new liquidity into the market. And so that's going to be critical. The second thing you want to think about when you think about tapering is you cannot raise interest rates before the tapering process is done. Simply put, that would be too much, too quick. Just as it would be too quick to start raising interest rates by 1% every month, you cannot begin to even have what we are calling liftoff until that tapering process is complete. So really, I think what we're seeing now in terms of market participants, we saw gold go up, but just nominally. I expected it to break through 1,800. I was wrong. I think the reason it was such a tepid rise is now that the news is out, what is the Fed going to do about it? Are they going to slow down the rate at which they taper, slow down the number of rate hikes next year so they don't crash the economy? Or are they going to look to have a devastating effect on the economy to put a handle on inflation? And that's a dilemma that, as I said, is untenable. I don't see a quick solution that can be done without pain and without damage to either the economy or the recovery. And that's why the Fed has such a quagmire that they're currently dealing with.
I know it's been a pretty rough month for metals. If you look back at November and the beginning of this month, we've seen quite a pullback, and it seemed like precious metals were going to break out, but then, we got that pullback. But your point of that there's no easy solution to this inflation, where do gold and silver go if we continue to see inflation for many years to come?
Well, see, that's the key. I personally believe that because it's going to be a long and drawn out process, regardless, and the fact that they have begun to, when I say they, market participants, traders, investors, have begun to factor in rate hikes into current pricing. When the realization hits them that this isn't going to happen overnight, and if, like I believe, inflation will continue to rise, there is going to come a point when they plan to focus upon gold as a safe haven asset. The dollar will no longer be a safe haven asset, and they will bid gold higher. My question is, what's going to happen to U.S. equities? Typically, they did okay today. They've been expecting inflationary pressures to rise. However, is there going to be a point when the interest rates are high enough to start to hinder the performance of these global U.S. equities or global companies based in the U.S.? If that occurs, excuse me, that's kind of like a 1-2 punch that could really take gold and to some degree silver higher. Silver also could benefit by the Build Better Act if they do have the ability to push it through and spend more money that we don't have, because going green requires solar panels, which require a lot of silver. So it's the kind of time where the analysts that are studied and have seen scenarios play out in the past have never seen this type of a scenario play out. The best we can do is look back historically and see what happened. And since there's really nothing that compares to what we are experiencing now, the best we can do is educated assumptions and hope that they're correct enough that we're giving value to those that listen to us. My sense over time is that at some point, it's going to be like the straw that broke the camel's back, and people are going to realize the dollar is really shrinking in values. One of the reasons we've seen gold go up is dollar strength. Gold go down is dollar strength. There's going to come a point when that might not happen, because as inflation mounts and grows, it means that each dollar buys us less. And to me, that's a devalued dollar, any way you want to look at it. So long term, I think we could see a tremendous run. How long will it take till that happens? That's almost an impossible question to answer, because I had assumed it might already start. It did not. We'll have to see what happens in 2022. We have to resolve the first thing, which is get a global program where people are healthy again, where we're not worried about this really contagious virus that has caused a pandemic. And then from there, we can then mount a reasonable economic recovery. The problem is we're trying to solve both of these problems at the same time. Then you start adding in inflation and other aspects, and it becomes a very complex puzzle. And that puzzle can only be solved by putting one piece in at a time.
Now, one question before we let you go. This is from a viewer. They're wanting to know, do you have an exit strategy when it comes to precious metals? Because for the next few years, I know you're looking for inflation and precious metals to rise. Eventually, though, they're going to be overvalued, right? As anything gets overvalued. So what is your exit strategy for precious metals, and what signs are you looking for?
Well, there's, first of all, multiple strategies, and they are based upon what your goals are. For speculative endeavors, I use the futures market. And in the case of that, I'm looking simply to catch a long-term trend which has been very difficult this year because we've traded in a choppy, narrowly defined market. But I look at recent highs and recent lows, and I like to play the ranges. But that is for speculation. I think that the question that is being asked is there an exit strategy for physical accumulation of gold and silver? So my question then becomes, whatever that strategy you have is, where will you move your hard asset, gold or silver, to that you believe offers you the same liquidity and protection? Real estate, land, is something that's gone up over time, but there's a problem with liquidity. So you've got to balance that out. In terms of the strategies, what I would look for is to use a technique that traders use simply called scaling. In other words, you build a position to a certain point, and when you feel that the market is overbought, you liquidate parts of it and then maybe look to reaccumulate it at the bottom. But my main question that I have to the viewer that's posing this question is, whatever strategies we can offer you, my question to you is, where would you move those assets to that made sense? One answer might be Bitcoin, cryptocurrencies. That's the Wild West. You could make a fortune, you could lose a fortune, and it doesn't have the stability that you get with gold or silver to a large extent. So the question is, what do you want to do with your wealth? If what you want to do with your wealth is send your kids to college or to buy a bigger home, and you have set goals, then as you accumulate, you say to yourself, I want to get to a certain level. When I'm at that level, I can scale out of some of these positions because the market is overbought, and then use that money to fund a college education, to use that money to move into a new property, to buy investment real estate. The question about what's your exit strategy for long-term accumulation, the first question is, where are you going to move it and what are your goals? Because those goals are going to define how you develop the strategy. In terms of the best way to have an exit strategy is to use a technique called scaling, which is where you take some off the table when it seems like prices are too high, and you add a little bit when you think that they're inexpensive. I know it's a simplistic approach, but scaling is the best way in terms of an exit strategy. My plan, personally, is that I hope I live forever, but it's really for my kids. I mean, I want them to have a financial foundation that is solid, and I think that if should I leave them a lot of dollars in a bank account that earn no interest, are probably going to be worth a lot less in 20 years, or do I leave them bullion? My sense is bullion. So for me, my exit strategy is most of my accumulation isn't even for me, it's for my kids. But for myself, what I accumulate to reach a goal, it's probably going to be my next property, because I want to get a bigger property, nicer view of the ocean, and that's how I would develop an exit strategy. A, based upon what your goal is. B, what asset are you going to move that into? Another thing you can look at, of course, is equities. When the equities markets are moving, if you see that gold is overbought, you might think of strategically shifting it. And that's how I would answer that.
Definitely. And for our viewers who are looking to accumulate, we have a special going on, kind of fun coins, 375 over spot. These are Noah's Ark coins. They're kind of fun. They're from the Geiger Mint. Just thought I'd let everyone know about that, 375 over spot per coin. But yeah, Gary, we really appreciate your time today. Before we let you go, any last thoughts you'd like to add, and where can our viewers find you online?
Well, you can always find us at thegoldforecast.com. On Twitter, I'm at Gary S. Wagner, and we have a YouTube channel called The Gold Forecast. But lastly, I do want to thank you. Thank you very much for naming your new coin after my son, Noah. I think that that was really, really a thoughtful move.
Well, you're welcome. You're welcome, Gary. Really appreciate it. So, and yeah, always we'll name the coins after your son. No worries.
So
But
next
we
one's
really
going to be good.
appreciate all your time today. Thegoldforecast.com. Once again, Gary, thank you so much for your time and God bless.
God bless. And to our viewers, be happy and be healthy. The reason I'm leaving out prosperous is I've never really been happy if I've been broke. Live to live a full life. This is a new normal. Enjoy every day. Make the best of it and realize that this will come to pass. And so appreciate what you do have and work at what you want to achieve. And that is what success is all about. Thank you for having me.
Thank you so much, Gary.
You're welcome.